All right, let's talk about two of the biggest names in Indian fintech heading for an IPO, Groww and Pine Labs. They're both giants, for sure, but their game plans are worlds apart. Today, we're going to dig in and figure out which one of these IPOs is the smarter bet for your money. So yeah, that's the big question on everyone's mind, right? Between these two titans, where should you put your cash? We're going to unpack that by looking at the hard numbers, the growth stories, and, most importantly, the hidden risks you need to know about. Okay, so before we dive into the deep end, let's just get a feel for who these companies actually are, because Groww and Pine Labs are playing in completely different leagues within the whole fintech universe. So on one side, you've got Groww. They are the rock star behind India's massive retail investing boom. You know, the app that millions and millions of people are using to trade stocks. And on the other side, you have Pine Labs. They're kind of the silent giant, the workhorse in the background that powers payments for businesses not just in India, but all over the world. One's about building your personal wealth, the other is about making commerce happen. Okay, let's get to the main event, the part everyone's been waiting for. The numbers. How do these two actually stack up when you put their financials side by side? This is where the story gets really, really juicy. So at first glance, you look at this and you think, case closed, right? Groww looks like the absolute champion. They're already raking in huge profits. Pine Labs? Well, they've only just started making a profit. But hold on, because the real story is so much more complicated than that. And here is where you really see the difference. Just look at Grow's numbers for fiscal year 25. We're talking revenue of over 3,900 crores and an absolutely staggering net profit to go with it. Their margin is a massive 60.8%. Now look at Pine Labs. They actually had a loss in that same period. But here's the kicker, the crucial detail. In the very next quarter, they flipped the switch. They turned profitable. Now it's a small number, yeah, but it signals a massive shift in where their business is headed. So let's circle back to Grow's incredible profitability for a second. There is one number that tells you everything you need to know about their biggest strength and also their biggest vulnerability, 62%. So what on earth does that number mean? Well, here's the catch. A whopping 62% of Grow's revenue comes from one single, super high-risk area, futures and options trading, or F&O. This is basically the high-stakes poker of the stock market. It's incredibly profitable for sure, but it's also really volatile, and as we're about to see, it's now directly in the crosshairs of regulators. Okay, so this brings us to the most critical part of this whole analysis. Risk. Because let's be honest, huge profits don't mean a thing if they could all disappear overnight, right? We need to understand the sustainability of those profits. And this slide just lays it all out perfectly. With Groww, you're looking at a huge external threat from a single source, regulators cracking down on their main cash cow. Pine Labs' risks are totally different. They're more about the day-to-day grind of business, managing tight margins and staying ahead of the competition. For Groww, the threat isn't just theoretical. It's happening right now. The market regulator in India, SEBI, is actively trying to curb the very F&O trading that's making them so much money. We're talking about new limits, tighter rules, you name it. Any of these changes could directly slam the brakes on Grow's profit engine. They are just so dependent on this one very risky thing. Now, Pine Labs is playing a completely different game. Their challenges are, classic business problems. They work on super, super thin margins, just a tiny fraction of every transaction. Competition is absolutely brutal, and they're carrying a good bit of debt, though the IPO should help with that. The key thing here is that their success is in their own hands. It's all about execution. So we've seen the flashy profits. We've seen the hidden dangers. After weighing everything, the massive profits against the massive risks, what's the final call? Which IPO really offers the better shot for an investor? And the verdict is in. The analysis actually points to Pine Labs. Now, I know what you might be thinking, wait, what? But Groww has all that profit. And you're right, but this verdict is all about playing the long game, about looking at risk versus reward. Let's break down exactly why. It really boils down to three key things. First, the price you have to pay for the stock, its valuation, is just way more reasonable. Second, the chances of one big regulatory change torpedoing their whole business is so much lower. And third, they just seem to have a clearer, more stable path to grow in the future. This chart just puts it all in black and white. You're being asked to pay a really high price for Grow's earnings, a multiple of almost 34 times. Pine Labs, though, it's being offered at a much more sensible 20 times earnings, which is right in line with the industry average. Basically, you're paying a huge premium for Grow's growth, a premium that doesn't seem to fully account for that big regulatory storm cloud hanging over its head. So, let's bring this all home. What does all this actually mean for you, as someone thinking about investing? How do you turn all this analysis into a clear, simple plan? Well, the final advice from the report is crystal clear. If you're an investor looking for steady, long-term growth, for stability, then Pine Labs is the recommended choice. Groww is for the investor with a much higher appetite for risk, someone who's prepared to ride out some potentially huge ups and downs. Ultimately, the choice really comes down to a question you have to ask yourself. What kind of investor are you? Are you looking for the stability of a global payments company with a clear path to just keep growing and compounding? Or are you drawn to the high-octane potential of a market-leading broker, even if it comes with a whole lot more volatility? The answer really depends on you.